Like we had reported, the November 3 MPC meeting had no rate action discussed at all. All we got was a one-liner from the Reserve Bank saying the MPC met and discussed the report to be sent to government, explaining why the MPC couldn't fulfill its mandate of keeping inflation below 6% for 9 months in a row. That report will also have to state what steps MPC intends to take to reach the inflation target and by when. That report, when it becomes public, can be very market-moving. Separately, the uber-hawkish statements of Jerome Powell will also have an impact on RBI's upcoming monetary policies. To discuss the RBI report and the impact of the Fed on India, I have with me Samiran Chakraborty, Chief Citi Economist, Citi India, Soumya Kanti Ghosh, Chief Economic Advisor, State Bank of India, and B. Prasanna, Head of Global Markets, ICICI Bank. Samiran, let me start with you. When the MPC report to government becomes public, why the MPC failed in its mandate in the past is a past tense. No, that's not important. What remedial steps it will take or has taken will be important, correct? As also the timeline the Reserve Bank gives to the government to reach the target of 4%. Wouldn't that be the more important ones?
Well, the way till now the RBI has looked at things, they have quite clearly stayed away from giving too much forward guidance in a world filled with a number of uncertainties. So at this juncture, while drafting the letter, it would be very difficult for them to lay out an exact path of how the policy response function is going to be. But one can clearly say that they will articulate the fact that whatever the COVID-related easing of monetary policy has been on both rates as well as on liquidity, that has now been practically fully reversed. Now, whether they will use the Powell kind of language of saying that we need to go to restrictive territory to control this inflation, that will be something interesting from my side to see. But otherwise, it's very difficult for them to give a precise quantitative target of how much more rate hikes or more liquidity absorption is going to be required to bring down inflation. For me, the more important part is going to be that are they going to just focus on inflation coming below 6%, or is there going to be a more active guidance towards taking inflation down all the way to 4%?
Okay, now to the more important question. Prasanna, would you say that after the FOMC's, or rather Jerome Powell's statements that, the terminal rate is likely to be even higher than what they thought, and now the market itself has moved higher in terms of its expectations, do you think the Reserve Bank, your expectations of hikes from the Reserve Bank have gone up? What are you expecting in December and later, a peak rate?
So I think, Lata, very clearly we have moved from higher, faster, longer to even higher, slower and longer. I mean, that's the way I would describe the Fed reaction. So basically we are looking at 5 quarter and 5 to 5 quarter or maybe even 5.5, we don't know. And we are looking at these hikes to, come over a little more slowly than the kind of urgent rate hikes that they were doing earlier. Now, what this has opened up actually is that I think while the governor's press conference yesterday was quite soothing and, calming kind of a statement, I think there is no other option but for the Reserve Bank to, kind of go with the Fed in terms of the direction. I'm not saying they need to do a one-on-one increase in the policy rate. So even if you assume a 125 basis point rate hike by the Fed from the current levels, which means we are talking about something like 5 to 5 quarter, even a 75 basis point rate hike from the RBI seems to be par for the course, because you can't let the interest rate differential to fall to too low levels. It's already on the lower side. So I would say that, yes, after yesterday, my inclination is to believe that the likely repo rate, terminal rate, or where they would likely to pause for some time has probably moved higher by 25 basis points from 6.5 to something like 6.75. And I'm inclined to believe that the next policy they will possibly would like to do 50.
Okay, Soumya?
more or less agree with what Prasanna said. I think one interesting, if you look into the press conference yesterday, if you look into the statements, the minutes of the meeting, they were a little bit dovish because it talks about, Powell clearly talked about the past rate hikes getting impacted. But in the press conference, the statements were very hawkish. So I think if I take the same logic over here, and given the fact that RBI inflation projection of 6.7% is likely to be underachieved, we are expecting that it could go up a little bit higher. 50 basis point rate hike for the December policy looks on course. There is always a scope that as the inflation gets down this year, then the RBI can look into the entire trajectory realistically. But as of now, if the Fed goes ahead with a 50 basis point rate hike, say in December, another 25 each, then RBI will have no option but to hike the rates incrementally. So maybe a base terminal rate of 6.5% and beyond looks the most likely option at this point of time.
Okay. Samiran, the Citi Economist, I think, has, the global Economist has, I think, upped their peak rate by 75 basis points. Any change in your peak rate expectations for India?
I think, Lata, where the markets are slightly confused is that the MPC minutes of the September meeting was somewhat more divided, where the couple of external members, they clearly articulated that the MPC mandate is only to look at the growth inflation balance and not so much on the external sector, current account, or the currency, for which RBI has other tools. So if you take that sort of a view, then it's difficult to justify why RBI will have to hike more than what we were expecting before. Whereas the other part of the committee tends to think that there is an indirect loop through the currency, which the exchange rate passed through onto inflation could make matters worse. And that's why there is need to do some kind of a preemptive hike in line with Fed. Whichever of these two arguments win will determine whether the terminal rate in Indian context would be higher or not. At this moment, we are still working with a 6.5% terminal rate, but we do acknowledge that the interest rate differential between Fed and RBI would become pretty narrow if RBI has to stop at 6.5. It would be a challenging task.
Well, Prasanna, basically now, should we be prepared for more rupee weakness, considering that the FOMC has turned hawkish?
Lata, that's, I think, obvious if you leave it to market forces. Obviously, the rupee will be a little bit on the depreciating bias. Just take into account the fact that the dollar index went to 114, then appreciate and came down all the way to 110. And that was when the expectations of the slower rate trajectory from the Fed was getting factored in. But what was clearly not factored in the global markets is the fact that there will be a higher Fed fund rate as well. So now what this has done is since yesterday, since the Fed meeting, is that the dollar index is again started, appreciating, and which means that there will be a depreciating bias to the rupee as well. But what is clearly not known is what is going to be the extent of RBI's, intervention, and at what level they're going to be really coming in and protecting the rupee, if at all. And one would have to assume that since they have actually spent quite a bit of reserves in the last 6 months, they would probably not have that much of, or wouldn't want to use as much ammunition that they've used in the past. So I guess it's a little bit of both, let it depreciate a little, but also come in and, kind of prevent huge volatility while it's depreciating.
Okay.
Keep in mind that the current account deficit is very much on the higher side still.
Soumya, would you concur that the market, the Indian economy, business people, India Inc. has to be prepared for a slightly higher depreciation? Do you have any number or range in mind for, say 2023 or just for FY23?
No, I think the rupee will continue to have a depreciating bias, and I think this there has been a slight shift in the Reserve Bank strategy. I think the last 2 months when they allowed the rupee to weaken below 80, because the NDF market was already showing the rupee below 80 in August, but the RBI was holding until the end of September. So my sense is that yes, there will be a weakening bias in the rupee, but what is important to understand is that at the end of the day, how far the central bank allows. So it will actually be a very delicate call between maintaining a value of the rupee and ensuring that at the same point of time, it has not a significantly impact on the inflation. But my sense is that, yes, there will be an impact on the value of the rupee.
Samiran, the Bank of England has also raised by 75 basis points. So there is a tightening, a serious tightening bias. The ECB has already done, and now the FOMC's peak rate is likely to be 5.5 or some, 5.25 or 5.5. Given that, should we be prepared for a higher current account deficit and therefore more pressure? Destination countries are tightening seriously.
On one hand, we have to deal with this somewhat unique situation where global growth is slowing down, but India growth is holding up. And that growth differential is causing our current account to stay relatively elevated. But on the other hand, in funding this current account, among multiple sources of funding, one particular source is going to be challenging, which is the ECBs and all, where whatever external loans will come up for refinancing going forward, there will be a tendency for people to try to shift from dollar into local currency borrowing, given that the interest rate differential has shifted quite a lot, and there is expectation of further currency depreciation, etc. So how then will you find the current account deficit, even if hypothetically current account deficit stays just about 3% of GDP? Would it mean that then the balance of payment deficit will continue much beyond FY23? And then what does RBI do on the FX intervention side? While all this is theoretically correct, one thing we should not forget is that RBI has not as yet started using any capital account measures on capital controls to restrict capital outflows, as well as encouraging more capital inflows. A central bank always has multiple levers to play with. So I would not be looking too far ahead to predict how this situation is going to pan out. RBI has pretty high number of levers to control the situation if it feels that the FX reserves has declined beyond the critical threshold.
Oh, thanks, Samiran. That's big. If capital, policies also will have to be visited. Thank you very much, Samiran, Prasanna and Soumya. I think the key takeaway is definitely the peak repo rate in India is going to be higher, maybe 6.75, definitely 25 basis higher than what people were thinking before the Fed meet. Also, a 50 basis point repo rate hike in India in the December 7th policy expected, and definitely more rupee depreciation is on the card. So 83 should come sometime. From the RBI report itself, what our experts feel is that they will watch out more for whether RBI speaks of more steps, and more importantly, what is the timeline to reach the target? And what is the target? Is it just under 6 or is it getting to 4? So that letter, when it is made public, will be very important. With that, we wrap up this special edition of Indianomics. Chart Masters coming up.